Is this the biggest lie in trading? Hi, it's Charlie giving you today's video. So this topic is around the banks that are out to get you. Not the bunks, there we go. The banks trying to run your stops, so to speak. So this is an argument that's been going around for years. So, the banks are out to get you. The market makers are out to get you. Right, okay. Now, firstly, I'm looking at highly liquid markets here like FX. Okay, I've got the euro dollar chart up. Highly illiquid markets are more likely to be manipulated. So yes, if you're trading meme coins and in the crypto world, and even some of the larger cryptocurrencies, they're more susceptible to large players, dumping a load or buying a load, and then off they go. So, but this subject has been doing the rounds since before cryptos became popular. Okay, so really my answer towards this is around highly liquid markets, stock indices, FX, etc., etc. So are the market makers out to get you? There's people out there trying to prey on people's fears, because one of the best ways to get people to follow whatever it is you want to follow them to do is to prey on people's fears. So, a stock market crash is coming. You've got their attention, yeah? So key drivers amongst people are what? Fear and greed. And one of the biggest motivators there is fear. So if you tell people there's going to be a stock market crash, then, you get newsletters doing that all of the time. So coming back to my original point, the banks are out to get you. Do you really think your 0.01 of a lot trade that banks are really interested in trying to stop you out? So even collectively, retail traders, even if retail traders are all putting their stops below a prior low, like there, or above a prior high, like there or there, do you think that the big banks, if we're talking about currencies, we're talking about tier one banks, are going to push the prices around to capture 1% of the total trading volume? Do you really think that's what's going on? It's not. They don't give a two hoots about what retail traders who are speculating on spread betting, CFDs, options, you name it, they don't care. They're not interested in that. They're interested in pushing the markets around, buying, selling the markets for their own reasons, not because they're thinking, if we push them that way, there'll be, there's some collective liquidity or stops amongst retail. It's just a fallacy. That you're just too small. All of us, myself included, I'm a retail trader essentially. We're too small collectively for those big tier one banks to be bothered about. Now, it's not that markets won't drive towards certain levels, but it's not for the reason that people think that it's a conspiracy and that they're there to try and stop you out. That's the point. Markets move and will gravitate towards, orders in the market. If there's lower volume, then the markets might move around towards let's say there was a load of orders here and the market was in a low volume environment, then it might drift down just to feed on those orders, so to speak. It's just that's the mechanism of the market. It's not a conspiracy that they're trying to stop you out. It's just that that's the way the market mechanism works. So if price comes down into that zone, yes, it may well then start to creep its way back up. It's not a conspiracy that they're out to get you, is my point. The market's done its thing. It's just filled a load of orders because it didn't have enough oomph, let's say, at that point. Let's say that didn't go higher. And they've just drifted along. It's filled a load of orders and then it drifts back up again. And so let's have a look at a chart here. So people are like, don't put your stops at a prior low. Well, okay, so if you've bought here for whatever reason, or wherever you've bought after this low, did price come back down to that low? No, it didn't. If you bought after this little tiny low here, even did price, and then price starts going up, did it come back down? No. So you can put stops below prior lows or above prior highs. Price isn't always going to come back for that high and stop you out, or a given low and stop you out. So I think, and if it does, so I could take this example here actually. This is a nice example. So let's use that. So if I zoom in slightly on this example here, in fact, I'll let you into a little secret. I'd actually shorted the week before. I placed a short over here. It was in late November. That's right. But I shorted with a given stop loss, and my stop loss was up here. It just so happened I knew anyway, I'm not going to go into the details of why my stop was here and why it wasn't above this high. Quite often when I'm trading, I will place a stop above a prior high or below a prior low, but it's not always the case. So on this occasion, I needed to give it a little bit more room because I knew that, well, price might nick back up to that little minor high there, which is exactly what it did. And actually on this day here, this was a non-farm payrolls day, and it was a mixed report. So I think the unemployment rate was worse, but the headline payrolls numbers was better. And wage growth was better. So we popped up on the reaction to the unemployment rate, and then we just rolled back over because of the other data within the report was strong, and so the dollar strengthened against the euro there. Anyway, technically speaking, then, if we look at that, and let's say you've shorted and you've got a stop, let's say above that high, then yes, we could go back to that and say, oh, look, yes, it did come out and take that high only to roll back over. So of course I could identify plenty of examples like that as well, but it's not a conspiracy, because there's plenty of examples, as I've just said, whereby price makes a high, starts to roll over, it never doesn't come back over to that high. And likewise this high here, once it's made that high and rolled over post that non-farm payrolls report, it didn't come back to it. Maybe it'll come back to it in the future. That's not the point. The point is it a conspiracy? We are absolute needles in a haystack. Don't see that you're, whatever you're trading at, 10 cents a pip, or even if it's $10 a pip, or $20 a pip, or whatever your amounts are, even if you're trading at $100 a pip, the market is so vast, running into trillions of dollars a day, that we are minuscule. The market is not going to run for your stop loss just to get you and then roll over. Now, it does happen that the markets, as I've already said, as part of the market function of filling orders, that price might at times come up, fill some orders, maybe that's what's going on. It's not. I mean, even on that day, the market ran up because it often happens that way. You get a reaction to the news of one part of a report, and then collectively market participants start scratching their heads thinking, actually, this report was actually reasonable. And then it goes the other way. So I think the main point is, don't think the market is a conspiracy. I know that's what most traders, so many out there, think. I've been doing this for 28 years, and in the year 2000, I was chatting with traders then, and they all thought, and so many people think there's a conspiracy somewhere or other. The game just moves on. I'm not saying that in low liquidity environments sorry, my phone's ringing at the moment. In low liquidity environments that, especially in things like crypto, those sort of things can go on with the big whales and players there. But generally speaking, in main financial markets, highly liquid, it's not happening. Just focus on your trading. Don't worry about things like where to place your stop to avoid the markets coming for you, because it's not a conspiracy. And I can show you just as many times when there's a low put in place like this one here, or any of these higher lows, actually the market doesn't come back down and take them out. There you go. Have a lovely weekend. I'll see you next week.